Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing ChargePoint stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ChargePoint is an electric vehicle infrastructure company. It operates the largest online network of independently owned EV charging stations across 14 countries. This company develops all of its technology for its charging ports. There are two main ways the company makes money. The first is selling charging stations. If Costco wanted a dozen charging stations at each store, it may contact ChargePoint and buy it from them. Another way this company makes money is through a cloud-based subscription service. You can use your phone to locate and reserve a charging station. If you are driving and you need to charge your car, then you can find the closest charging station in this company's network. In June 2017, the company took over 9,800 electric vehicle charging spots from GE. Prior to that point, ChargePoint managed 35,000 charging stations across Mexico, Australia, Canada, and the US. It reached 100,000 chargers in September 2019. If you went to either Disney theme park in the US and charged your car, then you use ChargePoint's product. As of 1/31, there are over 174,000 charging stations this company manages. ChargePoint was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In March 2021, the merger was completed. The SPAC that acquired ChargePoint was Switchback Energy. The company is headquartered in Campbell, California, and was founded in 2007. The ticker trades on the New York Stock Exchange and Sao Paulo Stock Exchange. Let's get started with the model. This is a mid-cap company, 6.2 billion market cap. They're trading at $18 a share, and they have 335 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. We only have 2 years of financial information, and they have negative free cash flow in both years. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative in both years. Revenue is the sales for the company, and that grew nicely from 146 million to 242 million. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that is positive in both years, and it grew from 33 million to 54 million. They do spend a lot on operating expenses. R&D is a big operating expense for them. Gross profit minus operating expenses gives you your operating income, and that's negative in both years. They don't have too much debt. They paid 1.5 million of interest on their debt. And they have a lot in other income and expenses. These are the gains or losses not part of the company's core operations. The gain on the sale of an investment or an asset impairment are examples of something in this category. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which of course is negative in both years. This is the company's income statement from their financial reporting. This is 2021 and 2022. This is the 3 months ending 1/31/21 and the 3 months ending 1/31/22. A bulk of their revenue is from the sale of charging stations, 174 million. Last year was 92 million. Their subscription revenue is up from 41 million to 54 million. And their other revenue is mainly tax credits. That's up a little from 14 million to 14.5 million. They are profitable in each category. Their expenses for all three are lower than the revenue they bring in. So they have positive gross profit of 54 million. Their gross margins were increasing. It peaked at 27% in the third quarter of 2022, but it's back down to 24%. But they're still small and growing their revenue. So over time, their margins should improve. They spend a lot in research and development because they come up with all the technology. So it costs them a lot of time and money to develop that. They spend a good amount on marketing, 94 million, and general and administrative, Example of this is payroll for support functions. So of course they have an operating loss in both years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And then you have CapEx, investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow, they're mainly running their business on equity. Most of their equity raises don't show up in Yahoo Finance. I'll show you in a little bit on the statement of cash flows. This is the company's operating cash flows from their annual report. And the way to calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. They reported an accounting loss of $133 million, but actually lost $157 million of cash flow. They have a lot of non-cash items on the income statement, $67 million of stock-based compensation, and a lot of fair value adjustments for convertible securities. They also had a cash outflow of $39 million in accounts receivables. This means they extended credit to their customers. So when the customer pays for the item, then it'll be a cash inflow in that accounting period. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And their operating cash flow is negative each year and getting worse because they're trying to grow their business, so they're investing most of the money back into it. But their revenue is increasing. If a company has losses each year, then looking at the price to sales ratio or the revenue in relation to the market cap is a good indicator to see how the company's doing. Their revenue is projected to grow a ton over the next few years, and it looks like by 2025 their operating cash flow should become positive. This is their investing and financing sections from their statement of cash flows. This is 2021 and 2022. In their investing section, they spent $16 million in CapEx. Last year was $11.5 million. And in 2021, they spent over $200 million in acquisitions. They did 2 acquisitions in 2021. That $200 million of cash from acquisitions is from these 2 companies. They spent $79.4 million on this company and $130 million on this company. For this second company, they paid $232 million. So they must have given $100 million of stock. This top company is a Dutch electric bus company. This bottom company is an Austrian-based charging software company. In their financing section, they received over $500 million from a PIPE financing, private investment in public equity. This is probably from the SPAC merger. They received $119 million from warrants. So in their financing section, they had a cash inflow of $550 million. Last year was a cash inflow of $129 million. Last year, they issued a bunch of convertible preferred stock and warrants. This is the equity section on their 131 balance sheet. They have $550 million of equity. They raised $1.4 billion from selling their business, and they lost $800 million from running their business. Let's look at the capital structure. They have $547 million of equity, $25 million of debt. They're 96% equity, 4% debt. And they could pay off all the debt with the cash on their balance sheet and still have $290 million of cash left over. This blue line is their equity balance since 2019. The green line is their cash balance. And the red line is their debt balance. They're not using much debt. It's mainly equity. Their equity is increasing at a similar rate as their cash, which makes sense because when you sell common stock, your equity balance goes up and your cash balance goes up. So they did have more cash than equity at one point, but some of the cash they spent were on assets that are put onto their balance sheet. That's why their equity balance went up. I gave them the highest whack on Finbox, 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 6, that's $5.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.6 billion. We divide that by 335 million shares. And we get a calculated stock price of $10.65. They're trading at $18.44, so they're trading at a 73% premium. It's a sell according to the model. Their revenue is projected to be about $900 million by 2025. In order to hit $900 million, their revenue has to grow by 55% from 2022. So I grew their revenue 55% for the next 6 years. That's how I got their future revenue estimates. And the average company in their industry converts 10% of their revenue into free cash flow. So I multiply their 2027 and 2028 revenue by 10%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow before then. The website Simply Wall Street values the company at $14. They're also saying it's overvalued. 12 analysts priced this stock and the average price target is 25, the low is 16, the high is 34. This is where the stock has been trading since it was a SPAC. All SPACs start at $10, and then once they announce an acquisition target, the stock price goes way up. There's a lot of buying, and then it usually crashes after that. A lot of SPACs have come down well below $10. But this stock has not come down below $10. It looks like it was getting there, and then it bottomed out at about $14. Now it's coming back. We might see another decline, or we may see a big run up. No one really knows. If you invested in this company when it first became a SPAC, or you invested in the S&P 500, you'd be up 90% with either investment. But you shouldn't be happy with a 90% return because you're taking greater risk by investing in this stock. They have a beta of 1.86, so the stock moves a little less than 2 times the market. It's a bit volatile. It's gone down 25% in the past 52 weeks, while the S&P is up 13%. The 52-week low is 11, the high is 37, and the stock is trading between its 50-day and 200-day moving average. This is a pretty popular stock. Over 10 million shares are traded each day. Of the 335 million shares outstanding, 209 million are on float. 48% are held by institutions, and it has a high short percentage. Nearly 15% of the shares are shorted. Their employee count has gone up in the past year. They employ 1,300 people. If you invested $10,000 into this company when it started trading, you'd have $19,000 today. That's a 90% return. In the past year, there's been a little insider buying, but a ton of insider selling. 1/3 of the company is owned by venture capital or private equity firms, another 1/3 by institutions, and about 1/3 from the general public. Only about 2% by individual insiders. Their biggest shareholder is Lindsay Capital at 21%, then Quantum Energy, Vanguard, Braemar Energy, and BlackRock. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is a bit high at 26, that's stock price over sales per share. And their price to book is also on the high side at 11, that's stock price over book value per share. Let's look at their non-current assets. 35 million of property and equipment, 140 million of intangibles. Most of their intangibles are probably computer software. 26 million of operating leases, right of use assets. This is when a company leases an asset that's owned by another company. 192 million of goodwill. Goodwill is the premium you pay when you acquire another company. And they have about 6 million in other non-current assets. Let's look at their non-current liabilities. 70 million of deferred revenue. Deferred revenue is when a customer prepays for a product or service before it's delivered. These are probably prepayments for its cloud software subscription service. 25 million of operating leases, 24 million of deferred tax liabilities. This should increase their taxes in the future, and 7 million of other. Their current ratio is 2.5 and their quick ratio is 2.3. Let's look at their current assets. 315 million of cash, 76 million of accounts receivables. This is how much money is owed to them. 35 million of inventory. Their inventory includes their charging stations, and 37 million are prepaid expenses. This means they prepaid for a product or service they're going to receive in the future. Let's look at their current liabilities. 28 million of accounts payable. This is how much money they owe others. 84 million of accrued liabilities. These are expenses the company has incurred but hasn't paid it yet, and 77 million of deferred revenue. They had negative 174 million of free cash flow in 2022, and they have 275 million of working capital. But it's pretty likely they're going to need to add some debt and equity to continue to grow over the next few years. The best way to look at ratios is to compare them to companies in the same industry. There are 56 companies in the same industry as ChargePoint, and they rank 15th in market cap. They're 6.2 billion. The average is 5.5 billion. Since they're a pretty new company and they're growing, they don't have good ratios, but their 3-year annual revenue growth rate is really good at 33%, much better than average. To summarize, I have them trading at a 73% premium. A big concern I have is that it's a SPAC, and SPACs tend to do really poorly. In order to have less greenhouse gas emissions and to try to move towards a greener planet, we want to try to get as many people using EVs. The first step is being able to afford an EV. There's a lot of people in the United States and even more people outside the United States who cannot afford an EV car. If you had a country with 100 million people and only 1,000 of them can afford to buy an EV, you need to build all the charging infrastructure all around the country, which is a lot more than those 1,000 people spend on those cars. If you're in a densely populated area like Manhattan, then it's a lot easier to build these EV charging stations. Even if more people in LA can afford an EV, there's just so many more charging stations they need to build because Los Angeles is so much larger than Manhattan. But I could see this company doing really well because there's going to be a ton of demand for EV charging stations. So there's definitely going to be some companies out there that are going to receive all that business. But no one really knows which company will be and which company will scale and grow the biggest. I ranked their free cash flows 1 out of 10, their revenue 5 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.